Welcome to the Deep Dive Library. We don't just skim books here, we really get into them, dissecting the blueprints for building serious enterprises. If that's your goal, well, you're definitely in the right place.
And today, we are diving deep into Louis D. Brandeis's Other People's Money, The Mission, to really unpack how financial power works, its influence often behind the scenes on the businesses that shape things.
Yeah, it's fascinating. This book is from the early 20th century, over 100 years ago, but honestly, his look at financial structures, it's still incredibly relevant if you want to understand how big business operates today.
Absolutely. So let's jump right in. Brandeis starts by looking at something President Wilson said back in 1911.
Oh, right, the money monopoly. Wilson thought it was the biggest monopoly out there.
Exactly. He felt it was holding back not just the economy, but individual potential too. This idea of concentrated credit.
Brandeis really digs into that, doesn't he?
Yeah.
How controlling the lending, the actual fuel for growth, ended up in the hands of just a few.
And it wasn't just about how rich they were personally, or even how smart.
No, it's something else.
Brandeis puts it as combination, concentration, intensive, and comprehensive. It was the system they built. He breaks it down into three strands, basically.
Okay, what's the first one?
First, you had the consolidation within banking. So banks and trust companies merging, sure, but also less obvious stuff. Shared directors, informal agreements.
So fewer truly independent sources of capital, less competition.
Precisely. Then the second strand was the consolidation happening in big industries, like railroads, utilities, the new industrial trusts.
Right, massive companies needing huge amounts of capital.
Which made them increasingly dependent on a small group of mostly New York bankers. It created this dependency relationship.
Okay, so banks consolidate, industries consolidate and become dependent. What's the third strand?
This is maybe the most critical part. The way investment bankers like J.T. Morgan's firm started getting involved inside these other companies.
Not just lending money, but actually
taking director roles on the boards of railroads, utilities, industrial giants. They were involved in creating and selling the actual stocks and bonds.
And it went even further, right, into life insurance companies.
Yeah, these huge pools of public savings. The insurance companies became massive buyers of the very securities these bankers were promoting, and the bankers moved into banks and trust companies too, controlling the flow of capital.
Wow. So they were positioned at every key point in the system.
Exactly. And this created dependence not just for the big companies, but for ordinary investors too. Brandeis notes, more women, more people not involved in management were owning stocks.
Yeah, and they relied on the bankers' reputations.
They really did. So goodwill, that established trust with customers, became incredibly valuable for these bankers selling securities. It gave them a huge edge.
And because they were often directors at the companies issuing the securities.
They could influence the whole process. The decision to issue, the price, everything. And then they'd profit from selling those securities. Brandeis basically asks, is it even a real negotiation if the same people are on both sides?
He definitely raises flags about fairness. And he points out these bankers didn't exactly love risk.
No, not at all. They worked hard to make sure there were buyers lined up. Maybe not every small investor, but they cultivated the big ones.
The institutional investors.
Right. The life insurance companies, the trust companies, other banks. If they bought in, it sent a strong signal to everyone else. Brandeis called them controlled corporate investors. They were clients and reliable buyers.
Okay, this structure, this web, it really leads into the idea of interlocking directorates. Brandeis called them the root of many evils. Let's unpack that.
Yeah, it's a core concept for him. Basically, it's when the same person sits on the board of directors for multiple companies, often companies that do business with each other, or might even compete.
So potential conflicts of interest are built right in.
Exactly. And Brandeis wasn't just talking about strict legal definitions. It was about any situation where you had these tangled, conflicting interests because the same people were making decisions in different, supposedly separate companies.
He gives that powerful example, doesn't he? Like a Morgan partner on the New Haven Railroad board.
Which needs steel rails. And that same partner is also on the U.S. Steel board, which makes the rails.
And U.S. Steel buys from GE, where there's another Morgan connection.
Right, and it connects out to Western Union, Pullman, Baldwin Locomotive, all these massive companies, all potentially doing business with each other, all using J.P. Morgan & Co. for financing and deposits.
The scale is just staggering. Billions of dollars in assets influenced by this relatively small group.
Over $16 billion, he calculated then, an immense sum. The point is, these overlapping roles inherently create conflicts. It undermines fair competition, potentially benefits the insiders.
At the expense of everyone else,
Yeah.
and it's still relevant when you think about corporate governance today.
Absolutely. And it seemed to fly in the face of a basic legal idea, right? That you can't serve two masters.
Yeah, Brandeis seems surprised that corporate law allowed this divergence.
Well, the courts did recognize that directors had a duty, a fiduciary duty to the corporation, but the way they handled conflicts was, well, weak.
How so?
Contracts where a director had a personal interest weren't automatically void, just voidable.
Meaning the company itself had to challenge it in court.
Exactly. And as Brandeis points out, citing the Pujo Committee investigation,
Which was a big congressional investigation into this whole money trust issue.
right, that committee found basically 0 examples of stockholders in a large corporation successfully challenging management over something like this. So voidable often meant perfectly fine in practice.
So the system kind of protected itself.
Which leads Brandeis to argue that banking, because it's so crucial to commerce and the money supply, shouldn't just be seen as a private business.
It should be treated more like fishes.
What?
A public service.
Pretty much, like a public service corporation. Banks have enormous power denying a loan can kill a business. That power, he argued, shouldn't be wielded to help the director's other interests.
He even brings up Justice Holmes, suggesting the state might even have to take over banking if private banks abuse that public trust.
It shows how high the stakes were perceived to be. Now, the Pujo Committee did suggest some fixes, like prohibiting directors from serving on the boards of competing banks.
But Brandeis saw loopholes.
Yeah, he felt it didn't go far enough. For instance, you could still have interlocking directorates involving multiple trust companies, which were also major financial players.
And he thought this ban should apply more broadly anyway.
Definitely. Not just banks, but life insurance, railroads, major industries, anywhere these conflicts could arise and stifle competition. He points to George F. Baker being a director for 6 supposedly competing anthracite railroads,
So the competition wasn't really real on some level.
often linked at the top by the same people, like the Morgan Associates connecting railroads that were meant to be rivals.
Okay, what about contracts? Did the Pujo Committee address companies making deals where their own managers had a financial stake?
They did, but again, Brandeis felt it was too narrow. Their recommendation mostly focused on officers of national banks.
Not broad enough to break the money trust, as he called it.
Right. He argued it needed to cover directors, too, and all kinds of corporations. He gives the example of the American Banknote Company having an exclusive deal with the New York Stock Exchange.
And Morgan was a major stockholder in the banknote company.
Exactly. It shows influence could work even without a directorship. Just having a big chunk of stock could create that conflict.
Makes sense. So even the proposed fixes, like rules about loans to companies where a director owns, say, over 10% of the stock.
Brandeis thought that threshold was too high. The principle should apply even with smaller stakes if there's a potential conflict.
So if regulation wasn't quite the full answer, what else did Brandeis propose? He talks about publicity, right?
Yes, the famous line, "Sunlight is said to be the best of disinfectants." He gave credit to the Pujo Committee for just getting the facts out there.
But he wanted more active transparency.
Much more. Specifically, he wanted investors to know exactly what bankers were making on issuing securities, their commissions, their profits, any bonus stock they got.
Why was that so important?
He believed investors had a right to know how much of their money was going to the middleman. And he thought if they did know...
They might balk at high fees.
Exactly. He called it a potential strike of capital. If the banker's take seemed excessive, investors might just say no. He cited a British case where that apparently happened.
And crucially, this information needed to reach the actual investor.
Right, not just be buried in some filing office. He imagined a prospectus that clearly stated, the banker gets X% commission and Y shares of bonus stock.
Total transparency.
Which, he argued, would help everyone decide if the banker's role was actually necessary, or just adding cost. Were they adding real value for that fee?
Which leads nicely into his idea of eliminating the superfluous banker.
Yeah, he felt that governments, cities, states, they were often paying bankers a toll, basically, just because bankers controlled access to the investors.
But if the city or state had a good reputation,
In a local market, they should sell their bonds directly. Cut out the middleman, save money.
what did he see as the legitimate roles for a banker in that process?
3 things. Expert advice, finding investors, and maybe holding the bonds temporarily, like underwriting.
Oh,
But
fair.
for well-known entities, he argued, you could get expert advice from independent accountants or lawyers.
And find investors directly.
Yeah, cultivate that market. Reach out to local people, savings banks, do some educational work.
Did this actually happen anywhere?
Oh yeah, it gives examples. Philadelphia, Baltimore, St. Paul, Utica. Cities that successfully sold bonds directly to the public, often getting better interest rates.
Interesting. So it wasn't just theoretical.
Not at all. He even suggested cities and states could cooperate, like Massachusetts did, to create a bigger, steadier market for their bonds, making them more attractive.
And this applied to corporations, too.
He thought so. Strong companies, like the Pennsylvania Railroad with its huge network, could appeal directly to their stockholders and the public. He really pushed back on the idea that bankers were essential protectors of investors.
Especially given debacles like the New Haven Railroad.
Right, which happened under the watchful eye of top bankers like J.P. Morgan himself.
Okay, so if bankers weren't always essential, what about the claim that they were the drivers of big industrial development? Brandeis challenges that too, doesn't he?
Vigorously. He basically says, hold on, let's look at the history.
And what did he find?
He goes through railroads, steamships, the telegraph, McCormick's Reaper, Carnegie Steel, the telephone, electrical innovations, even the early auto industry.
And finds that the initial push, the innovation, usually came from individuals, pioneers, local money.
Almost always. People like Fulton, Morse, Bell, Carnegie, Ford. The big banking houses often came in later, once success was proven.
Often to consolidate things, create trusts.
Yes, more often facilitating combinations than sparking the original invention. And he argued those very trusts, created by the bankers, could actually slow down innovation.
How so?
By discouraging newcomers, buying up patents maybe, making it harder for independent inventors. He even quotes President Wilson on that danger.
And he gives the example of GE controlling water power.
Yeah, illustrating how these huge consolidated companies could exert influence far beyond their core business, potentially hindering alternatives.
Okay, so Brandeis is really questioning the necessity and even the benefit of this extreme financial concentration. What about the argument that sheer bigness just required it?
He tackles that head on. He says, sure, businesses got bigger, but were all those huge stock and bond issues really for necessary expansion?
Or were they just for creating combinations and mergers?
Or often, yes. Sometimes creating inefficient or even illegal combinations. He uses the Union Pacific Railroad, showing how they funded a lot of improvements from their own pockets, not just massive new banker-led issues.
And he saw downsides to the combinations themselves, especially in railroads.
Big time. Loss of independence, inefficiency. He points to messes like the Rock Island-Frisco merger or the Cincinnati-Dayton setup. Even the mighty Pennsylvania Railroad's investments in other railroads didn't always pay off well.
So he supported regulation, like what the Interstate Commerce Commission was recommending.
Very much so. Regulating combinations, regulating how securities were issued. He saw this as key to decentralizing finance, giving smaller businesses a chance.
And the New Haven Railroad keeps coming up as the cautionary tale.
It's his prime example of banker management failing, despite J.P. Morgan being deeply involved, maybe because of it.
There's that quote from the railroad's president, Mellon, basically saying Morgan called the shots.
Yeah, admitting deference to Morgan's greater confidence, and yet the railroad ran into serious financial trouble under this expert guidance.
But Brandeis says it wasn't just about Morgan making bad calls.
No, he argues it's the system, the inherent conflict when bankers are trying to be both financiers and managers. You need undivided loyalty to run a business well. Bankers, he felt, should be advisors, financiers, but detached from the day-to-day running.
It's interesting that even the Interstate Commerce Commission seemed surprised by how poorly these supposed financial wizards performed as managers.
Right. These magicians somehow couldn't run a railroad efficiently. Brandeis says it boils down to fundamental limits.
You can't serve two masters.
Exactly, and you can't be an expert in everything. Running a complex railroad or a steel company requires specific knowledge, not just financial acumen. Their private interests as bankers inevitably conflicted with their duties as directors.
Like with U.S. Steel, putting financiers in charge of a massive industrial operation.
Or the New Haven, which wasn't just a railroad, but this sprawling web of trolleys, steamships. Incredibly complex. How could financiers truly oversee all that effectively?
He pushes back against the idea that only these few oligarchs were capable of being directors, too.
Yeah, he basically says, come on, there are plenty of capable people out there, which leads him to explore alternatives, like the cooperative movement.
The English Cooperative Wholesale Society. Tell us about that model.
It's fascinating. Owned and run by the retail co-ops it served. Sourced goods directly, paid fair dividends back to members, directors elected democratically. It covered everything from food to manufacturing.
And it worked. It was efficient.
Apparently very efficient and with much lower overhead, especially executive salaries, than comparable American companies. It showed a different way was possible: democratic control, mutual benefit.
And this wasn't just a one-off in England.
No, he mentioned similar successful movements in Scotland, Sweden, Switzerland. They were actually a force in curbing monopolies there. And he saw the beginnings of it in the U.S. too, retail co-ops, federations forming.
He also talks about cooperative banking, right? The German farmers.
Yes, the credit associations. He calls it democratic banking by the people, of the people, and for the people.
How did that work?
Farmers pooled relatively small amounts of money, managed it themselves democratically, one member, one vote, and loaned it out to each other at very low rates, hugely successful across Europe.
A stark contrast to the banker-dominated savings banks in the U.S.
Totally different philosophy. He also highlights Alphonse Desjardins starting credit unions in Canada, which then inspired laws in Massachusetts and the growth of people's banks here.
It really paints a picture of alternative possibility.
It does, and Brandeis wraps it up by echoing President Wilson. True prosperity comes from the broad base, the unknown men, not a tiny controlling elite. It's about empowering wider participation.
So, distilling this deep dive into other people's money, the key themes are really the dangers of concentrated financial power, the limits and potential conflicts of banker-led management, and importantly, the viability of other models like cooperatives that prioritize broader participation.
Which really brings us to the final thought for you listening. How can we take these century-old insights from Brandeis and apply them today? How can individuals, communities, maybe even businesses foster economic systems that are more resilient, more equitable, and less prone to the pitfalls of concentrated power?
Yeah, how do we encourage that broader participation in creating wealth? It's definitely something to think about in terms of how you view business, investment, and the economic structures around us.
Absolutely. And look, if exploring Brandeis's ideas sparked even one new connection for you, think about what you might gain from joining us regularly. We dissect these foundational texts every week. Make sure you subscribe, because missing out on these kinds of insights, that could be the difference.